What's up, you guys? Welcome back to the channel. My name's Jonathan. Thanks for stopping by today. Today I want to talk to you about futures. Not the future, but the trading product futures. Depending on your trading experiences, futures may be new to you, or they may be something you're very familiar with. Futures are very diverse and very interesting topic. It's something I learned a lot about doing research for this video. Before we get started with a practical example for futures, if you haven't yet, go ahead and subscribe to the channel and hit the like button. It really helps out the channel. Okay, let's get started on the video. This video is the third of 4 videos in my product overview series. So far I've covered stocks, ETFs, and ETNs, and today we're going to cover futures. In the future we'll go through options. I'll walk you through futures from a high level, and then we'll dive into some of the details. Futures have a delivery date or a settlement date. Futures contracts are traded. Futures are based on an underlying stock, commodity, exchange, currency, or interest rates, and we'll look at a lot more examples coming up. There is an obligation to take possession at the delivery date, or if it's a settlement, then to settle up at the settlement date. And this is on both sides. These are obligations for both the buyer and the seller. Some examples, and these are equity futures, are ES, which is S&P 500 E-mini, DM, which is Dow Jones, and NQ, which is NASDAQ. The price is the market price at the time a futures contract is bought or sold. This market price references the market price today of a future that will be delivered in the future. With all that out of the way, let's look at a simple example of a practical future. During your vacation planning, you probably make a checklist of what you need to do. Some of these items may include buying a flight ticket, buying tickets to an art gallery, choosing the right hotel, and booking the hotel. An example here that I like to walk you through is buying the flight ticket. Flight tickets are practical examples of futures. When I'm going on vacation 6 months from now, I want to book my ticket today so I know how much that flight in 6 months will cost. Plus, I can guarantee that that flight has my name on one of the seats. I could alternatively just wait 6 months and then buy the flight at that time. Then I run different risks. I run the risk of the price changing, and maybe it gets really expensive and I can't afford it anymore. I would also run the risk that there are no more seats left on the flight I want to take. In order to avoid both of these risks and make sure I get the flight ticket to the island getaway that I want to reach, I'll agree today a price for my flight in the future. A more concrete example is a flight between JFK and Los Angeles. I checked the flight price on 2 Mondays, one at the end of May and one at the end of July. The price of the flight at the end of May, which is about 2 weeks from today's date, is $184. The price of the flight at the end of July, which is about 9 weeks from today's date, is $139. This difference in price shows that different delivery dates or settlement dates have different prices. Now, with my example out of the way, let's take a look at what are futures. My by-the-book definition of futures: they are contracts between a buyer and a seller. These contracts are for delivery or settlement at a specified date in the future. With our flight ticket, it was 6 months from now. And the price is the price we agreed today for delivery in the future. The price we agreed today for delivery in the future is almost certainly different than what the price I would pay today for delivery today. Next, I'd like to take you through some of the my explanations for why futures are needed. My first point as to why futures are needed are to reduce the risk of changing prices. Going back to the example of a flight, both the airline and myself want to reduce the risk of changing prices. For me, the changing price would be of the ticket, and it could be that the price gets cheaper and I get a better deal, but it could also be that the price gets more expensive and I can no longer afford the ticket. For the airline, it's similar but inverse. The airline wants to know how much revenue they're going to have in the future when they deliver that flight. So by agreeing to sell the flight to me at a certain price, they already know how much revenue they will get on that day. The airline will also be having futures contracts on fuel and other things. All of these things added together will give the airline the needed information to plan and execute their plans. The second aspect for me as to why futures are needed is to secure something when I need it. For my flight example, I need my flight when I'm on vacation, not today when I'm currently working. In order to do this, I'm willing to enter into a contract with the airline to make sure I have this flight. And it could be that I pay a premium, or it could be that I get to pay a discount. Now I want to look at some of my principles of futures. Principle number 1. The price of the future reflects today's expectations for the future. If the date I want to fly is a date that the airline expects won't have a lot of demand, they may sell it to me cheaply, versus if I book an early morning Monday flight, which are normally flown by business travelers, it may be a very expensive flight. The second principle is that futures are settled or delivered at some point in the future. Some futures have physical delivery, and we'll look at some of those examples in the coming minutes. Some are cash settled, which means buyers and sellers just get the amount of cash or had to pay the amount of cash in order to bring their P&L, their cash balance in line with their P&L. And the third principle is that they match future costs and prices. They could also match future prices with today's cost, or future costs with today's prices. It just depends on how you look at it and what side of the business you're in. So my first point about trading futures is that futures allows a trader to have a lot of leverage. I've said in videos before that leverage can be a good thing or a bad thing. It is truly a double-edged sword. Futures traders are allowed to control large nominal amounts of a commodity or a currency or whatever it is they may be trading with a small account balance. This amount of leverage will allow them either to make oversized gains based on a return on capital or oversized losses based on a return on capital. I'd be excited to hear from you guys if you know exactly at what margin percentage futures can trade at, or if you have examples from your trading. Let's look at some of these examples of futures. My first example is currency. The prices of currencies are traded in future contracts, the price for delivery at a future date, and this is one of the largest markets in the world. The practical purpose for this is that companies operate in different countries, in different currency environments, and in order to bring their money home or to provide funding for a project or payment to a vendor, they need to be able to pay in the currency specified in the contract. To reduce the risk of prices changing and incurring costs that have nothing to do with the project or product or company's core businesses, they use future contracts to hedge this risk. Two more examples are wheat and corn. These are both commodities, both grain products. Producers and consumers, so farmers and let's say cereal makers, use future contracts to secure prices that they can work with today. Farmers may make the decision to plant or not to plant based on the future price of their product. Cereal makers can use the future price of the grain that they need to help determine at what price they need to be able to sell their product at in order to cover their costs. Gold is a fourth example I have of commodities that are traded in futures. Gold miners need to know how much they can sell their gold at to know if it's worth the cost to mine it. If a gold miner's costs exceed what the future price would be, they may shut down the mine for a while until the price of gold increases. My third point about trading futures is cash settlement versus physical delivery. If you want to trade futures, it's very important to know if the future you're trading is cash settled or if there will be physical delivery required. If you're trading oil futures and you let the expiration date be reached, you'll be required to accept delivery or deliver oil to a specific geographic location on a specific date. If you can't do this, then you will have a problem. Therefore, if you're trading futures with a delivery specification, it is best to make sure they're closed out before they expire. If you're trading futures that are cash settled, an example would be the VIX, then letting the future expire will just mean that your account will be debited or credited with more cash or less cash. It may still be wise to close out the future, close your position, and lock in whatever profit or loss you have beforehand, but that would be an individual trading decision and would not require you to take the risk of needing to deliver or pick up product at a certain location. Needless to say, futures with physical delivery requirements are very different from stock, equities, bonds, or cash settled futures. Okay guys, let's wrap it all up with my summary and my perspective. The first point, and for me, the point that makes futures a lot of fun, even though I don't trade them in my trading, is that they serve a real economic purpose, an everyday purpose that even if you don't think about it, you are a part of. They reduce the risk of changing prices. Reducing this risk and tying future delivery to today's price for the future delivery is a way to help companies plan, consumers plan, and just overall make markets move smoother. And that is point 3, enabling planning. Knowing what things cost in the future before the future arrives makes planning a lot easier for companies and individuals. Number 4, almost all futures are optionable. I haven't found any that aren't, but I have found some with very small volume and open interest. This is important for me because I do trade options. Trading options on futures is a viable plan. Futures offer a lot of leverage. This means you can control a lot of a commodity or a lot of currency with a very small account balance. This can lead you to having a very high return on capital and a very successful trade, or it can lead to you crashing your account overnight. Therefore, I don't recommend anybody runs out and takes a leveraged position on futures without understanding leverage and without understanding the futures. Risk management is your friend. Okay guys, so there's my perspective on futures. Let me know what you think down below in the comments section, and while you're at it, go ahead and leave me any suggestions you may have for future videos. That's all I have for you today. Until next time, keep trading and keep trading well.